In this recording for Tennessee Master Row Crop, we will be discussing crop insurance and corn, soybean, and cotton price outlook. So when we look at crop insurance prices, they were finalized as of the end of February. And so when we look at our spring planted crop insurance prices for Tennessee, for corn, the price is $4.58, up from $3.88 compared to last year. Cotton at 83 cents compared to 68 cents last year. Soybeans at 11.87 compared to 9.17 last year. So what we've seen is an increase in projected spring crop insurance prices. This is obviously a positive, provides us a better starting point in terms of our revenue guarantee for crop insurance. It is important to note that our sales closing is fast approaching, March 15th. So get with your crop insurance agent to finalize your crop insurance products. One thing that we do indicate to people is to expect premiums will be a little bit higher. So there might be some sticker shock in terms of what the price is relative to where we were last year. But it's important to realize that we've got a much higher coverage level. The other one that factors into this price or this premium calculation is price volatility. And what we've seen was prices more volatile during the price determination period of February 1st to February 28th. And so again, the combination of higher coverage levels, increased price volatility during the price determination period will have, for the same coverage level, increased premium costs. So, work with your crop insurance agent to see what you can do in terms of products and how you look at those trade-offs between revenue guarantees and premium costs. It is a positive overall, though, because it does create a different in-season risk profile than last year. One of the ones that we'll talk a little bit later about is we have seen an increase in input costs as well to go along with the increase in price. So, you do want to protect the higher value of the current crop. And as always, work with a qualified crop insurance agent to determine what the most suitable coverage is for your operation. There's a lot of great crop insurance agents out there. Lean on them in terms of making sure that you get the products that are suitable for your individual operation. So we look at just kind of a basic example when we look at soybeans, for example. With that price of 11.87, if you have an APH of 45 bushels per acre and you buy up to 75% coverage, that would give you a $400 per acre revenue guarantee. Compare it to a cost of production, and obviously cost of production, there's a wide range of what the cost of production is across the state and even across different operations. So you want to come up with a cost of production number that you can end up comparing to your revenue guarantee. This will help you a couple of different ways. One, it'll allow you know what you've got in terms of risk exposure during the marketing season. And it's great to end up sharing this with your lending institution, because it does show you what the risk that is out there in terms of revenue during the growing season. A couple of real just basic questions that you should ask yourself and your crop insurance agent is, can I increase my APH? That'll obviously have some positive implications in terms of your revenue guarantee. What should I increase my buy-up coverage level, or can I drop it down and add an area product? Again, you have to be cautious with the area products because they aren't necessarily specific to your loss. So you could get a county, if you had a county level product, for example, you could end up having a loss on your operation, but if the county doesn't trigger, you don't get a payment. You could also have the opposite happen where the county triggers a payment, but you maybe didn't have a loss on your operation. So just be careful with that. Do I have the correct unit structure? Obviously, discussing whether enterprise, basic or optional units is more beneficial for your operation is important. Enterprise, you're obviously going to have lower premium costs, but again, that could come at the cost of not having the production that or the protection that you're looking for the individual field level units. What other crop insurance options are available for my operation? I would bring up the conversation of SEO and ECO with your crop insurance agent. Some of those products may be beneficial to producers in Tennessee. Again, it depends on how your individual farm relates to the county in terms of yields and trends. So we look at this, I did kind of just a quick example to kind of visualize how we look at unprotected revenue in excess of the crop insurance guarantee. So I use that 450 cost of production, which is this red line, and then that 400 revenue guarantee for crop insurance, just to give you an idea under a 45 bushel per acre estimated yield and different price scenarios, how much revenue is left unprotected. And again, we want to factor that into our in-season marketing plan. Now, with that being said, I will provide a cautionary note. Crop insurance is not a substitute for marketing. It is a complement in a risk management plan. So we always want to make sure that, yes, we are considering how our crop insurance selections influences our marketing decisions. But again, those two aren't substitutes, they are complements. So again, make sure that those two are working in conjunction. Obviously, you can cover off certain aspects using futures and options that can be covered with crop insurance as well. So what you want to do is look at the efficiency. You don't want excess premium on the crop insurance side, and you don't want to end up having, similar levels of protection through your marketing plan and increasing those transaction costs. The other thing that is important to point out on the crop insurance standpoint is the spring price does set a minimum in terms of revenue protection if you select a revenue protection product, but we do have the option to have that go up based on the harvest price. And so again, under the current circumstances, I would in general recommend not or making sure that you maintain the harvest price adjustment. I wouldn't opt out of that. I think that there's some real benefits, particularly if we had an adverse growing season, to be able to really benefit from having that harvest price adjustment. But work through those scenarios with your crop insurance agent. But just as a general blanket statement, I think that's a real important level of protection when we move through the growing season, is maintaining that ability to move the guarantee upward. So to kind of switch it over to kind of the crop outlook, I think this statement is really important right now. There's some cautious optimism in commodity markets right now on the row crop side of things. But you do want to protect against the downside. This is a quote from Dr. John Anderson at Texas A&M. He's their cotton specialist. And I really think it's timely and kind of hits the nail on the head in terms of a marketing strategy moving into this year. And it just says, doing nothing all season is a strategy. It avoids upfront option premiums and possible futures margin calls. But the cost of this strategy is bearing the risk of lower prices all season. In that sense, doing nothing is the ultimate form of speculation. And so again, there's lots of fundamentals we'll get into, the supply and demand basics that are pointing to prices being at current levels or kind of, trading where we've seen it, definitely higher than the previous 3 years. But again, you always do want to make sure that you protect against those big potential price declines. And so when we look at this just in terms of basic fundamentals, I kind of broke it down into two different sections: factors affecting supply, and then we'll talk about factors affecting demand on the next slide. So when we look at supply, I think it's been well documented that for prices, we have very tight US and global ending stocks, low stocks to use ratios, which would be beneficial for maintaining prices. High prices for many crops make acreage decisions competitive and regional. So again, when we look at Tennessee, we have the three primary spring crops: cotton, soybeans, and corn. All of them, you can make an argument there's an incentive to increase acreage relative to last year for sure, but we only have a certain number of acres. So we'll have to see how that works out. When you go up into places like the Northern Plains, it expands the number of spring crops that they're planting. But in general, most commodities or row crop commodities are very price competitive as of right now. There are some concerns down in South America, particularly with the second crop corn. The soybean harvest has been delayed a few weeks down there, and so they're not going to necessarily get that crop into the ground as quickly as they would in a normal year, and that could have repercussions on their production potential. So we could see a reduction in that second crop corn crop out of Brazil. There are a limited number of export competitors when we look at the global market. Obviously, we have Brazil and Argentina for soybeans. And then when we look at corn, we have Brazil as well as Ukraine and Russia in terms of, and Argentina in terms of providing, export competition. But there's not as many exporters or substantial exporters as there are in some other commodities like wheat. When we look at Brazil, logistics are always a concern down there, and that translates directly into when exports are available on the global market. In terms of negatives and uncertainties for prices, planted acres in 2021, we have some initial estimates that we'll talk about. But again, a lot of that is going to be dictated by what happens with planting weather, and then, through the growing season, how does weather end up potentially affecting, production. And so when we look at it, one question that we have is can we grow our way out of a rally in one production cycle? And the answer to that is yes, we can. The one that is more uncertain is will we? And so when we look at that, it doesn't look like there's a high probability that we will see prices fall back to where we were, over the last 3 years. Obviously, what our yield expectations are as the season progresses will continue to adjust. I think there's more opportunity for corn to grow our way out in one production cycle than soybeans, but I don't see either one of those causing prices to fall back where we were 3 years ago. Record Brazil production is on its way. There is a tremendous demand for soybeans out there, but it is something where once that starts hitting the markets, we will see big purchases, primarily from China, but from several other countries. How big that demand is pretty substantial based on what we're seeing. But again, another record crop coming from Brazil. Added acres, global production. There's the old saying, high prices will cure high prices. And so we would expect as we move into this planting season and into the South American planting season, if prices are at the same level, there will be an incentive to increase the production area in key producing countries, as well as maybe on some of the periphery regions that maybe wouldn't have as much production normally. When we look at one of the negatives, obviously rising input costs. We'll talk a little bit about fertilizer because that highlights the rising input cost environment, but fertilizer is definitely not the only input cost increasing. We mentioned crop insurance, but fuel is another one where we see, some substantial increases. Machinery costs are up. So again, we love seeing the higher prices, but what we're really looking at is what's our profitability, and with the rising input costs, that is going to end up shrinking down what were some robust profit margins when we look back a couple months ago, where maybe input prices weren't as high and we did start seeing the rally in the commodity markets. There is a near record long managed money position, so institutional money in corn, cotton, and soybean wheat futures. And that in itself is not necessarily a negative. It did contribute to the increased futures prices, but what it does is it potentially creates the opportunity for some increased volatility in those futures markets. So when we look at factors affecting demand, again, we'll break it down into positive for prices and then negative to uncertain for prices. So positive for prices, USDA is projecting record US beef, pork, and broiler production forecast for 2021. Those animals are going to eat. So again, that's a positive in terms of domestic demand, which is really important. I think we've seen a bit of a bounce back in ethanol, but the one that I'm really looking or interested to see if it can really take another step is, can we get more exports of ethanol to countries? China is one that's obviously a very important player in that, but the EU, other areas as well, Brazil. There's opportunities in export markets for ethanol. Whether policy and international trade agreements support those, we'll have to wait and see. The other one, obviously with the new administration coming in, they've got some different priorities. We don't know how necessarily something like carbon policy, for example, would potentially benefit ethanol. So again, that's another one that's maybe uncertain, but if realized, it could be a positive for corn prices, for example. We see strong domestic crush in soybeans. That's the demand side of the equation is really what's propelling us to these higher prices, which is really positive. We have a near 5-year low in the US dollar index. So again, that does stimulate export demand for products, makes our prices relatively cheaper to those that have a stronger currency. So that is providing a little bit of tailwind still in terms of demand. Export purchases to China. Obviously, we've talked about the phase 1 trade agreement. USDA is projecting those to remain strong. When I was listening to their Outlook conference a couple of weeks ago. I was even a little bit surprised how strong they were anticipating export demand for ag products to China, which is obviously a tremendous positive for prices. And we do still have increased global protein demand and meat consumption, so that's another positive for demand. In terms of negative, COVID-19, there's just uncertainty there. I can't predict, or nobody can predict what's going to happen there. Similarly, African swine fever, it's been well established, the reduction over the last couple of years in the Chinese herd and then the subsequent rebuild. These infectious disease outbreaks, I don't necessarily think they're going away, but it's something where you could end up seeing, adverse demand influences based on African swine fever or some type of avian influenza. There's probably several blind spots that we can't identify at this point in time in terms of having reduction in animal feed demand. High prices can limit demand and result in substitution. Now, this one is maybe a little bit more challenging because we do have high prices for a lot of commodities. The one that I would look out for here on the global stage is wheat. We do have substantial global wheat reserves that could end up creeping into the feed market. Now, again, with where prices are, that is going to kind of limit that substitution a little bit, but there's definitely the opportunity to have some movements based on relative prices. China is the kind of epicenter of the demand pull right now in terms of globally. And anytime you're talking China, there's a huge amount of uncertainty with policy, geopolitics, and the information coming out of China. Everything that we do hear and read has to be taken with a grain of salt. And then global economic uncertainty, bouncing back from COVID-19, and what that environment looks like is going to also be very important. And so then when we look at kind of a subsect of that global economic uncertainty, we really don't know what we're going to get in terms of global and specifically U.S. trade policy with the incoming administration. I don't see massive overhauls in the near future. What the long-term direction, it looks right now like it's going to be more multilateral trade agreements than bilateral trade agreements. But I think everything will kind of be kicked down the road until we get out of this COVID-19 uncertainty. So I wouldn't expect that until maybe the third or fourth quarter of 2021. I don't want to dwell too much on global supply and demand, but there are some interesting trends here that we do want to make note of. So this is for corn. When we look at corn consumption, we've had it exceeding demand and stocks falling for 4 years in a row. So for the remainder of this marketing year, 45 billion bushels of consumption, 44.6. Anytime you have consumption exceeding production, that would be supportive for prices. Similarly, with global soybean production and consumption, we've seen stocks fall the last 2 years. And similar to corn, we've got consumption expected to exceed production. And so again, there's two factors in there. One, it's reducing stocks, but it is also providing incentive to increase production. Cotton is one that's interesting. You don't see the huge decline as of right now in global stocks, slight decline year over year. And we do have domestic consumption on the global standpoint exceeding production. But one of the big ones that I think has really benefited cotton is that the COVID-19 disruptions, when you think about the retail sector, there was a lot of very real concerns about how it would affect retail demand. And fortunately, what we've seen is maybe we haven't seen the long-term disruption or demand drag be as severe as what was initially anticipated at the start of this pandemic. And so we've seen tremendous rally in cotton prices. We're on the nearby, over 90 cents, even on the harvest contract, we've bumped up right up against that 90 cent level. So the real positive here that I do want to point out is it is demand that makes relevant other factors like production and stocks. Without that demand draw, it's not as important what production and stocks are doing. And right now we're in an environment both with domestic consumption of corn and soybeans, and then global demand through exports for corn, soybeans, and cotton, where there's real strong demand pulls, and it's projected as of right now to continue into 2021 and potentially into the 2022 year. And so that's a very positive factor that should help us maintain prices well above where we've been the last 3 years. As I mentioned, China's been a dominant factor. And just to give you an idea across these 3 primary commodities, where we've been in terms of US exports to China, when we look at corn, obviously we're about halfway through the marketing year. And you can see there's really no comparison to what we've done over the last 3 years. Now, obviously, we have to put this in context with the trade disruption that occurred over that same time period. But this is phenomenally strong export demand by China. And we anticipate that this will likely continue, maybe not at the same frantic pace or the upward slope in demand. It will likely level off a little bit. But corn's a little bit different than soybeans in that we do still have some reserves. We don't have as much as we have in previous years. They have tightened, but there is still some reserves that we could end up continuing to export. Whereas when we look at soybeans, we're basically functionally out in terms of increase. And yes, there's sales that haven't been shipped yet. We expect those to be shipped, but we don't anticipate seeing large USDA revisions to exports because we just don't have the stocks. And we'll show that you know, in a couple of slides here. But again, we've seen fantastically strong soybean export demand by China, and it's already started to creep into the next marketing year, so the 21-22 marketing year. So again, it's a real positive in terms of the demand pull that we've seen for commodities. Here's cotton, you know, very similar, where we've actually started seeing some sales in 21-22, and you know, just very strong sales so far in this marketing year from China. So there's a real positive in terms of maintaining prices. So we look at kind of the domestic balance sheet. This goes for both the current marketing year and then the USDA's initial projection for 21-22. And what you will see is you'll see some parallels to where we are in the current marketing year 2021 and then 21-22. And so when we look at how much stocks we are estimated to have left, 1.5 billion bushels of corn for this marketing year and 1.55 billion bushels for next year. And you can also see the aggregated demand where we have consumption in red and then exports in yellow. So, you know, we're anticipating increased demand and stocks roughly at the same levels. Obviously, we are a long way out from having a real clear picture as to what's going to go on with the 2021 crop, but the initial projections are very positive for prices. Similar with soybeans, I mentioned before, you know, at 120 million bushels left over projected at the end of this marketing year, we're functionally out in terms of exports. You could see some minor revisions on some of the USDA numbers. But again, that's something where we expect that demand to really shift down to Brazil and start eating into that estimated record crop. When we look out to the 2021 marketing year, again, very uncertain as to these estimates, but maintaining strong demand, you know, ending stocks at 150 million bushels, very tight again. So we see, you know, some positives for prices as we forecast out into the next marketing year. Cotton, you know, similar picture. There's a running theme when we look at this production side is the very strong demand equation and the continued tightening or the maintenance of reasonably tight ending stocks in the U.S. A drop from 4.3 to 3.8 in terms of ending stocks for cotton, very supportive to having prices. And you can always go back and kind of take a look through the slides, and you know, you have to be cautious with comparing marketing years to past marketing years because every year is definitely different. But you can pick out some trends in terms of what's happened on the supply and demand side, and then how does that implicate or how does that give you some ideas of what's going to happen on the pricing standpoint. When we look at projected planted acres for 2021, obviously there's a huge amount of uncertainty. We'll have to see what weather brings. The USDA Ag Outlook Forum projected soybeans at 90 million acres. That's up 6.9 million from last year. Corn at 92, up 1.2 million. Cotton at 12 million acres, down 90,000. I would caution on this cotton estimate just because when this estimate came out, you know, there was definitely strength in soybeans and corn. But over the last 2 months, we've really seen cotton accelerate in terms of relative prices. So it would not surprise me if we've seen this up closer to that 12.5 to 13.5 million acres when we see the prospective planting report at the end of March. And so again, very competitive price circumstances for acres. A lot of this will be dependent on if we see reduced prevented planting acres in 2021. When you look at nationally, 2019 and 2020, we had very high prevented planting acres. That's why you see an increase. We could see this also erode into other commodities and potentially pick up some acres that weren't planted to row crops in most recent years, because there is a definite price incentive to increase acreage across commodities. When we look at Tennessee, USDA hasn't released their numbers yet, so I kind of ran some just basic numbers in terms of what we would potentially be planting. Soybeans near 1.7, corn, just under 1 million acres, and cotton 325,000 based on the strength in prices. And again, so this is up over last year across the board. So some of that acreage is going to be made up from a reduction in prevented planting and some periphery acres being brought into production. Now again, like I said, we're not in the planting season yet, so that planting weather and prevented planting is really going to influence where we are. I think that's what the next major market mover is. We've seen some initial estimates. We will continue to see estimates as we enter this planting season. But in general, there's an incentive to increase planting for most row crop commodities. It's not all great news in terms of on the row crop side of things. We have seen input prices on the rise. I'm not going to dwell on this today because I will have another video talking about input prices. But when we look at fertilizer prices, this goes all the way back from 2014 to February 2021. And what you've seen over the last couple of months is that prices have basically just went vertical, where we've seen tremendous increase. And I didn't include the UAN slide, but I mean, there's the same type of general price trend where we're just seeing much higher input prices, and it's not limited to fertilizer. I mentioned expect increases crop insurance, premium prices, very small amount of production, but still, we want to be cognizant of all of our input prices. And then when you look at things like fuel as well, very strong input prices. When we look at December corn futures, what I did on here is I kind of looked at what the futures price behavior was from the January of the year until when that contract expired, and then compared it to the national market year average price. And so I'll use 2013 as an example here, where the average of the December corn futures contract from January 1 until expiration in December 15th was 507. But really, the average is important to consider, but what we really want to also be aware of is what's the minimum, min and the max, or what's that range that prices traded in. And so when we look at minimum 412 to 594 gives you a range of 182, and a national market year average price of 446. So this does give you some reference in terms of where the USDA is projecting national market year prices and how that might translate into futures market price behavior. Obviously, there's some big differences on a year-to-year basis, but this does give us an idea of what we can potentially see in terms of price direction. When we look at 2021, this only includes January and February. So we would expect, this range to expand as we get, the volatility through the planting and growing season. When we look at basis, obviously corn basis has been very, very strong. We would expect with the strong demand draws both globally, and then also Tennessee with our strong livestock and ethanol sectors, that we will see basis still being very robust and probably exceeding the 5-year average as we're moving into 2021. One of the big things, and I think it's one of the most powerful marketing tools that we have, specifically in Tennessee, because of our strong livestock and ethanol industries, is can you store that production? Being able to have the capacity to take advantage of seasonal price movements is so important, so that you can end up getting that price premium for your commodity. These on-demand calls that you can get from ethanol and poultry feed providers, or contracting some of that production, can really provide some beneficial opportunities for producers. When we switch it up to November soybean futures, Again, what we're looking at here is what that average price is for the November soybean futures contract from January to expiration, and then what the max and the min range is. So again, we did see a widening in 2020 where we had just over a $3 trading range from that low of 839 to a high of 1143. Obviously, that was on the very end of that contract. And when we look at 2021 so far in the 2 months that we've completed, not quite $12 a bushel. And again, we're at the high end of where this range is. So there's some optimism in these prices. You need to, anytime we're talking about futures prices, you do have to incorporate that basis projection in there as well. And I mentioned, on corn and on soybeans, we do have very strong basis numbers, and there's nothing that would signal a warning sign that we're going to see a large step back in terms of the strength of our basis in the 2021 year as of right now. We look at cotton futures. This is one where we've really seen the increase, at the later part of January and into February, where now we're bumping up close to that 90-cent range on the December cotton futures contract. There's really not a great year of comparison for cotton. Cotton is somewhat different than comparing back to maybe that 14, 15 area for corn and soybeans. As I mentioned, it's difficult to compare years directly or under completely different circumstances. But again, what we're looking at here is what that volatility was. Hopefully we don't get back, where we're seeing this amount of volatility back then in 2010, 2011, because there are some concerns, if you do get prices sustained at some of these high levels, that really could erode some of the demand that's really triggered how high prices have went. But again, as of right now, we're looking at a very optimistic outlook in terms of prices for the 2021 cotton crop. One of the most common questions that I've been getting recently is marketing strategies that protect the downside but allow for price increase. So I put up two. There's multiple tools that you can end up using. There's many different scenarios that you can work with, options that can accomplish your goals. But two of the more commonly used ones would be buying puts. You can do that with or without premium offset. So setting up a fence or selling a put at a lower level to end up generating some premium that you can offset for the put that you ended up buying. Or you can forward contract or short hedge and then buy calls. That gives you some ability to participate in rallies in futures if the futures market continues to end up going up. But what we really want to do is we do want to take some of that risk off the table. Some people will be very comfortable using these types of tools and investigating strategies on their own. For those that aren't, obviously you can reach out to UT Extension, or there's several brokers out there that can really walk you through and give you an introduction to this. If this isn't something that you're comfortable with, reach out. There's a large support network within the state that can really provide some benefits in kind of walking through how these strategies work and how it reduces the risk on the downside. One thing that we always need to point out is these strategies do come at a cost. Obviously, there's premiums associated with this. But again, if it's going to help you sleep at night to take some of that downside risk off the table, I strongly encourage people to investigate these opportunities. So just kind of in closing comments, understand the current market environment and continue to evaluate price projections and yield potential throughout the marketing cycle. This is a snapshot in terms of what we are looking at right now. There's no guarantee that this couldn't change potentially dramatically within the next couple of months. Right now, again, I'm cautiously optimistic that we will be able to have prices near current levels with the potential for upside if we do end up getting some adverse weather conditions. I really highlight people to evaluate your storage capacity relative to anticipated production. I think it presents a lot of opportunities. Using tools like the Tennessee Ag Enhancement Program can end up helping offset some of the cost if you do look at increasing storage. Availability is going to be an issue. I have a sneaking suspicion there's a lot of storage capacity that is going up there. So, trying to communicate and understand what type of timeline you're looking at. The other thing that I do kind of want to close with is the amount that a producer is comfortable pricing at different times of the year is operation specific. Obviously, it should be also factored in how much of your production you can store. If you can store all of your production, I still think you should price some production pre-planting, but it does extend your marketing window. It's a different risk profile than if you have to sell everything before harvest, right? Then you might want to get a little bit more aggressive forward contracting or short hedging, or however you choose to end up pricing your production. So, just kind of as a very general statement, have some of your production priced to planting, 25 to 50%, depending on comfort level. But I would caution about pricing your way out of an extended rally. And so, options provide some additional flexibility, but if you are using cash forward contracts or a short hedge, if you are priced up to 75+%, if we did see a weather disruption in the Midwest or the Northern Plains, you may not be able to take advantage of it because you've sold such a high level of your production before planting. The other one that does bring into the factor is if you do end up having your production is estimated at this time of year. So if you overprice that, you can actually trade price protection or price risk for production risk, because you might not be able to get the production that you were anticipating. So that 25 to 50% gives you kind of a starting point where you can add on during the growing season as you know more about your production, where prices are headed and how that's going. I don't think it's too early to start evaluating 2020 opportunities. I'm not even sure if I'd dip a toe in the market yet right now, but at 432 on the December 2022 contract and 1098 3/4 as of March 2nd, I would pay attention to those because I think there is the ability to end up at least getting a little bit priced if we do see a sustained or continued rally. So, making sure that you're not just looking at the current crop, but future opportunities. If you think that you can make money when you end up running your cost of production at those levels, I'm all for taking some of that price risk off the table, because we do have a tremendous amount of uncertainty the further we move out. So in terms of price projections, obviously we have some very wide ranges here. We've got a lot of volatility. We don't expect that to end up going away. Excluding cotton, old crop prices have kind of been moving more sideways in the last month and a half. And so again, we might end up seeing that continue. There is some potential to see some increases as we enter the summer month based on what we see in crop progress. Our next major market mover is likely going to be what planted acres are in planting conditions. That prevented planting influence has been so prevalent in the market in the past 2 years, just with the reduction in acres. We'll have to see what that ends up bringing. So, given where we're at right now, I guess I'll close with saying take some of that price risk off the table. Expect some volatility as we move through these uncertain time periods. And when you're looking at pricing, I am a big proponent of looking at incremental pricing. So start early, and if we do see a continued rally in new crop prices, and you can set it however you want. You can do 10-cent intervals, you can do 25-cent intervals, but maybe if prices for corn go up 10 cents, maybe you want to price an additional 5 or 10% of your production. Now, obviously you don't want to overprice, so you have to continually reevaluate. But right now, things are reasonably optimistic. We have some reasonably good pricing opportunities. See where you are in terms of what you need based on your cost of production or your investment in the crop, and make your pricing decisions accordingly. As always, if you do have any direct questions on any of this information, please reach out to me directly. I'm available through phone or email. We are still working remotely, so I wouldn't encourage you to phone my office number, but phone my cell number that's on the screen, and I would love to work through any scenarios that you may have. With that, thank you for attending, and we will have another video in the next couple of weeks.